It's no secret. I've mentioned it in the Chat with Traders podcast in 2016. Every trader that's ever known me knows that I'm a little bit crazy when it comes to leverage. Okay, I can go from trading really, really well with 5 lots or 10 lots or 15 lots or 20 lots, and then suddenly I have 100 lots on. Okay, so I can suddenly put on this crazy amount of leverage, all because of emotion, because of feeling, because of intuition. And the reality is it's hindered my career for a very, very, very long time. Okay, a number of years. And that's why I created this tool, because this tool is a product of my biggest weakness. Now, why I'm sharing this tool with you in this, this course ultimately, is because in my opinion, this is the single biggest breakthrough for me as a trader. Okay, and this breakthrough came in 2018, 2019, whilst I was developing this tool, whilst I was developing an understanding about risk and how risk works for traders. Now, the objectives I'm trying to achieve and the objectives you're going to realize and recognize with this tool are as follows. Firstly, you're going to develop and deploy a strategy. Okay? It's a predefined strategy to risk management. So it's not I come in the morning and I feel like risking this and that. No, it's predefined. You follow a strategic process, just like you follow a strategy, with trade execution. Okay, it's also predefined. In other words, when you are about to trade or you get a signal, you don't have to think. It's predefined. The strategy tells you what to do. Okay, you're going to allocate risk with an objective and a holistic approach. In other words, too often we want to double an account very quickly. Okay, too often we get caught in the heat of the moment or the heat of the bias or the excitement, the Vegas lights. This tool gives you a holistic approach to building your account over time, to developing consistency over time, and it teaches you how to allocate risk at the right instances. Repeatable, consistent risk management process goes without saying. How often do we come in one day, we're trading X amount of leverage, and then a few days later, maybe we read some social media, maybe we've got a really good trade setup, and suddenly we have an inconsistent approach to risk. It'll help you to reduce and eliminate over and under risking. Okay, in other words, that's that example of we typically risk $100 per trade, and then all of a sudden, because Brannigan put out a tweet about being long and I wanted to be long, I risked a lot more, substantially more than I would. Okay, this will it'll reduce and eliminate over and under risking. Okay, and it's important I stress that it's not just over risking that's a problem for traders. And a lot of you you'll see this when I go through the tool, but a lot of you can associate with this. How often do we under risk? How often are we a little bit fearful? Maybe the last 3 trades didn't go so well. Maybe we're close to our stop on the day and suddenly we're like, well, I don't really want to get stopped out today. So instead of risking 100 on this next trade, I'm only going to risk, or I'm going to reduce my size. Okay, so this tool will eliminate that. It'll force you to trade in a consistent way. Why? Because when we're winning and losing, we want to win and lose with the same size. We don't want to get into the habit of winning with 1 lots, but losing with 10 lots. Okay, because that process in the long run will not give you longevity. Now we want to segregate, and this is key, we want to segregate the risk decision-making process from the trading process. And this is what I said to you, is that when we get a signal, that's the trading process. Okay, there's a signal, I now need to access this breakout trade. Now, how much risk we put on that breakout trade is 2 completely separate decisions. Okay, remember that example I showed you, how we can get into that bias of this breakout trade's coming, I've tried it twice, 3rd time, damn it, I'm going to be lucky. 3rd time, we over risk, we put on more size because of confluence, because of all these emotions and thoughts coming to our head. But the reality is that inconsistent process ultimately leads us to a destruction or to a very big down day. Okay, so we segregate, and what we mean by that is the trading process is one thing. When the signal goes off, that tells us, Brannigan, you now have a trade. The next part of the process is I go to my system, as you'll see when we get to the tool. I ask the system, Mr. System, how many lots must I use? The system says, Brannigan, you use 2 lots. Okay? The system's not biased. The system doesn't know what's going on in the market. The system doesn't care. All the system looks at is, what is Brannigan's strategy and what should Brannigan be doing in this instance? That's all the system knows. Okay, so we segregate the trading process from the risk process. Develop a methodical approach to increasing your account balance through effective risk management. Okay, how often do we struggle to grow an account? How often do we see ourselves stagnate at whatever 10,000 or 20,000? Okay, how often do we feel like, well, we have to take a draw again, and we don't really want to risk too much more because ultimately we have bills to pay, etc., etc. Right? This tool is going to help you increase your account, but it's going to do it methodically. We're not going to go from 10,000 to 20,000 overnight. No, it doesn't work like that. We are going to have a very nice incremental growth curve. And when we go through some of the performance charts in the tool, you'll see what that growth curve looks like. Okay, you'll see, the power of, for example, what, compounding growth looks like on your account balance. You can see what a forecast looks like of your 6-month potential account balance. Okay, all of these will be contained within the chart, in the tool. Reduce variance in risk allocation. Okay, this is making sure that we are consistently increasing our leverage over time. Okay, but also not having too much variance. What do we mean by that? If I typically trade 2 lots, I don't want to go to 4 lots tomorrow. Okay, I'll be 2 lots for the next couple of days until my account balance is at a certain point where it can satisfy and hold up trading 3 lots. In other words, the risk makes sense to now start using 3 lots or more leverage. And then again, we get used to 3 lots. We get used to the risk of having a little bit more size, but we do it over a period of time. Okay, and when we're ready, when the account is ready, then we take that next step up and we start leveraging a little bit more. Okay, so we go through, we reduce the approach or the variance within risk allocation. Loss acceptance. Okay, every single trade, you know exactly what your exposure is. You know exactly how much money you're going to lose. Okay, it's not guesswork. The system's going to tell you, you are going to lose this much. You'll know exactly how much you can lose on a day. And that gives you peace of mind, because think about it. If you know the worst case scenario, if you trade like an absolute muppet, okay, sorry for the English word, but if you trade like an absolute muppet on the day, ultimately the maximum loss, call it 5% of your account. Okay, not so bad. Right? You will always know what your maximum exposure is on any trade, what your maximum exposure is on the day. Okay, and that gives you peace of mind, because you know that even if the worst happens, you'll wake up tomorrow, you'll come back, and it's business as usual. Okay? You're going to develop a confident approach to risk deployment. In other words, you're going to have a very confident approach as to how you allocate risk in the markets. Okay? And it goes without saying, confidence breeds confidence. Okay? And the more confidence we have in our system and our strategy, ultimately, the better our account growth. The better our account growth, the bigger traders we become. Okay, so you can see how this builds on itself over time. And lastly, develop edge or alpha with a disciplined risk management process. Okay, it goes without saying, if you trust this tool, you will develop an edge. Okay, why? Because most traders don't understand what risk management is. They don't understand the power of risk management. Now, I'm going to let you in on a little secret, just a little secret. The success of every Axia trader that I know to date, okay, and I know all the big hitters in Axia, the success of those traders all borders on one simple common denominator. It's not the strategy. Okay, it's not the strategy. A lot of you think it's the strategy they adopt. It's not. It's the risk management process they adopt. Okay, that is the reality. If you can manage risk, you will develop edge. You might not even have good strategies, right? But you can still make a lot of money with strategies that have got very low hit ratios, so long as you've got a very effective risk management process. Okay, hopefully you're starting to get excited now. Now, we're getting to the end of this lesson, but what I want to do is just show you, and you've seen this graphic before. This is where we're at now. We're in the middle point here. Okay, and this is what I was talking about, isolating pre-risk exposure. So before we take a trade, all of these things are taken care of, all of them. Okay, the filtering, the signals, the access, all of that is pre-trade. The moment we have money at risk, the moment we have the potential to lose capital, We want to be on this line and this line only. We do not want to have anything, causing us doubt, anything making us think anything other than the objective information coming in. Okay? We don't want to think, how much leverage should I use because I just got a signal? No. Okay? We take care of the controllables, and that's what this tool's about. It tells you the moment a signal goes off, Brannigan, use 10 lots. Okay? You don't have to think. All you focus on is what's coming in front of you in the markets. Okay? The objective information. Clarity of thought, ultimately. Okay? And then obviously, like mentioned, we have the post-risk exposure. So once we get out of that trade, once the system says, there's your stop, once you get out, then we have that discrete opportunity to now reflect, to make conscious decisions, to ultimately improve on all of this before we then take exposure again. And that's this entire course in a nutshell. Okay, you will see when we get to, I think it's lesson 23, we're going to go through this entire process. Everything you see here, pre-risk exposure, risk exposure, and post-risk exposure, we're going to go through that entire thing in an example. Okay, I'm going to show you how the entire process works. And hopefully by then you'll see why it's so powerful to control the controllables, which is here. In this instance, to focus 100% on what's in front of you, and then make sure that you're debriefing and reflecting. Now, risk management and poker. Trading is similar to poker, okay? Discipline, consistency is the key to success in the financial markets. Okay, you have to have consistency. It goes without saying. We've spoken about the power of consistency through our truths. Now, having a plan doesn't guarantee success, and this is important. Remember that example. You come in the morning, you do all the hard work, you're right on direction, you have the right trade idea. That doesn't guarantee you success, okay? But you have to have a consistent loss control process. You have to. Okay, because it's the consistent loss process that gives you longevity. It allows you to come back tomorrow, take the same idea, and hopefully in that instance, the probabilities are in your favor. Okay, so you want to stick around when you have a hand and bail when you dealt a bad hand. That's what trading is. When it's not a good trade, just get rid of it. Free yourself. Okay, don't go through the 5 stages of loss. You don't need to. Get rid of the emotion. Skip straight to stage 5, which is we now have a discrete event. I can now learn from that and move on. Okay. Your plan is structured so that when your position is working, you stick around, and when it isn't, you get out. Okay. Take the loss and don't worry about it. Why? Because, hey, our risk management system has told us that the worst case scenario on a day-to-day basis is only X amount, which isn't so bad. Why? Because we predefined it. Now, if you drop your discipline and you try bluffing, okay, if you use this risk management system and you try to bluff it, it's got guardrails in place, okay, and those guardrails are to help you avoid bluffing, okay. Why? Because when you bluff, you're exposing yourself to losing all of your money, right? That's that scenario of sometimes when we do a really bad thing, sometimes we'll get away with it, but most of the time in the long run, all those bad things accumulate to blowing up accounts, accumulate to loss of confidence, and ultimately leaving the industry. Okay. Now, before we get to the end of part 1, I'm going to go through the 4 types of risk management strategies that you are going to be exposed to in the SRM tool. Okay. I'm going to go through them with a basic example so you understand the basic essence of it. Now, this comes directly from the tool, which I'll introduce to you in part 2. So first and foremost is the equal risk weighting. Very straightforward. If I'm willing to lose $1,000 per day, okay? Equal risk rating is just simply allocating an equal amount of risk per trade. So if I typically do 10 trades a day, it means that I will be risking $100 per trade. No more, no less. Okay, so that's the first type of risk strategy, which is we risk $100 for every single unique trade. If we enter a trade and we suddenly $100 down and our stop gets triggered, okay, we move on. We've lost $100 on the day, but we still have $900 of exposure. Okay, that's the equal risk weighting. Now, the second example is what we call ABC risk strategy. Okay, so instead of having an equal weighting, we now allocate the weighting. So what we say is that some strategies have got higher probabilities than others. And therefore, in the higher probability strategies, we want to risk a little bit more. In the lower probability trade strategies, we still want exposure, but we prefer to risk a little bit less. Okay, so this strategy, in the first example, we can see that because we typically do 10 trades a day, we are risking 10% for every trade. Okay, doesn't matter which number trade it is, we're always risking 10% of our daily stop per trade. In the ABC risk strategy, we can now allocate. So we say our best trade setups are ones we've back tested, the ones that we know that have got very high hit ratios or very high probabilities of working. We want to allocate, for example, 50% to our best trades. So 50% of our daily stop of $1,000, okay, means that in the A trades, we're willing to lose $500 on that trade. In our B trades, we only want to lose 20%. Okay, so we want to lose $200. And in our C trades, well, these are kind of our gamble trades, right? So we only want to lose 5%. In that instance, we're only going to lose $50 per trade. Now, hopefully you can see that if you were to follow this process of ABC risk strategy, it only allows you in effect to take two A strategies per day, because if you were to get two A setups in one day and both of them got stopped out, you've then fully utilized your entire day's risk in two trades. Okay, so this is a far more aggressive risk strategy, and it's also super important that you only utilize this risk strategy if you understand the probabilities of your trade setups. In other words, if you've done enough backtesting on your trade setups to justify having different percentage risk allocations. Okay, now don't worry, knowing which risk strategy to pick, when we get to the tool, I'm going to show you a process that you will follow to determine which strategy you should be using. Okay, now the last two risk strategies are what we call fractional ERW. ERW just stands for equal risk weighting, and fractional ABC. Now, the only difference is that fractional simply means that we reinvest a fraction of our profits. So how does it work? Okay, if we are at 0 on the day and we've now selected the fractional ERW, the equal risk weighting, and don't worry, when I get to the tool and when we get to lesson 20, I'm going to take you through examples of this. I'm going to show you what it looks like. Okay, if we have fractional equal risk weighting, okay, and we typically risk, like we said, $100 per trade. Okay, so we're willing to lose $100 for our trades, which is 10% of our daily risk. Okay, and our daily stop is $1,000. What the fractional ERW is, it says if we are positive on the day, and I will show you another example of this, but if we are positive on the day, and only if we are positive on the day, we will reinvest a percentage of our profits into our next trade. So for example, let's say trade number 1 we take on and suddenly we lose. So we go minus $100. Okay? The very next trade we do, we're still only risking $100 per trade because it's equal risk weighting. However, let's say we won on our first trade. So let's say on our first trade, we didn't go to minus 100, but we actually went positive 100. On the next trade in this instance, we will risk our $100, which is our equal risk weighting, plus we will risk a percentage of this profit that has been realized. In other words, we take the profits, the realized profits from the market, and we reinvest them into our next trade. And we will define what percentage of our profits we want to reinvest. Okay? Let's say for hypothetical purposes, we reinvest 20%. It means on our next trade, we are risking 100 plus $20 into our next trade opportunity. Now you can see how this is powerful, because what we're trying to say is that when we're profitable, when we're trading well, when we're in the flow of things, we're reinvesting more and more into that next tradable opportunity, which means if we're trading well, we can have bigger and bigger up days. Of course, there is the flip side, which is that, yes, we also potentially can lose our realized profits on the day a little bit quicker. But that's okay, because remember, ultimately, those, again, suppose it depends on how you look at risk management, but ultimately a realized profit is no different on the day. A realized profit is no different to realizing a profit at the end of the day. Okay, so you always have to think of every trade as a unique tradable opportunity. Just because it happens during the day doesn't mean that you should be fearful of that next trade. Okay, so this is a way that we can reinvest our profits into that next trade opportunity and be more aggressive. Okay, this is a more aggressive form of risk management. Now, again, like I said to you, don't worry too much which strategy you're going to use. We'll go through a process where you will choose, ultimately based on your questions and answers, you will choose what the best risk approach is. Okay, and the last one is the fractional ABC. So again, it's precisely the same as the ABC, where we allocate a percentage per A strategy, B strategy, and C strategy. But again, when the account is positive on the day, in other words, when we've realized. So note, it's not if there's an unrealized profit. Okay, so if we're in a trade and it's $200 on side, but it's still unrealized, okay, that doesn't count. In other words, you will not reinvest unrealized profits. You only reinvest the profits that have been realized. Okay, they are yours. They are physically, you can take that money, you can switch off, and your account will be credited at the end of the day. Okay, so it's only the realized profits that we reinvest. Okay, so exactly the same as fractional ERW, except we don't use the ERW to work out the initial $100, but we work out the ABC percentage to work out the initial investment. Okay, so it'll be the exact same 20 reinvestment. That doesn't change. The only thing that changes is the $100. If, for example, it was an A strategy, one of our best ones, we'd be risking $500 plus 20. Okay, so we'd risk $520 into the next trade. Now, I will take you through an example of this fractional ERW and ABC so you can see the power of mathematics in it. Okay, that's all risk management is, by the way. It's just basic math. And it's using things like compounding. It's using things like probabilities to your advantage. Okay, you can see how, if we've got some really good strategies, you can see how you want to risk more on those good strategies versus the poor ones. Okay. You can also see, though, how powerful an equal risk weighting can be if you prefer to have consistency, less leverage, and less variance in your risk approach. Okay. If you're not someone that likes having big swings in your profit on the day, you'll tend to focus more on the equal risk weighting options. Right. So all you have here, right, and this is why we've put them in this order, all you have here is varying degrees of risk averse versus risk appreciative. And the order goes from the top, you have the most risk averse strategy, and at the bottom, you've got the most risk appreciative strategy. In other words, if you're a cowboy and you like the Vegas lights, you're probably going to be using this strategy. Okay, it's not that straightforward. Please don't think it's that straightforward. You must go through the questionnaire to find out what is suitable for you. Okay, but the more risk you like to take, the more you want to have very high returns and you don't mind the big swings in P&Ls or big drawdowns, the more you'll be leaning towards this approach. The more risk averse you are, or if you're a beginner trader, you'll 100% be leaning towards this approach. Okay, the point is, every one of these strategies offers a unique strategic approach. They are all powerful in their own way. They are all unique strategies. Every one of them has got pros and cons. Okay, every one of them is good in some sense, bad in another sense. The purpose is you will align the strategy based on your personal objectives. And we're going to talk about these objectives at the start of part 2. Okay, so those are the 4 risk strategies you're going to be introduced to when we get to part 2 of lesson 19. Now, this is a good summary. Reinvestment principle, we're just simply leveraging on our profits. Okay, so we're taking the realized profit, we're taking the money that's already ours, and we're saying, hey, we don't mind taking a bet with this money. Okay, that's all it is. And we do that because we want more leverage. We want to have bigger winners. We want to make sure we can have bigger up days. Note, we only have the reinvestment principle when we are up on the day. So we're positive on the day, never when we're down. If we're negative on the day, we do not leverage more. Why? Because when we're down, we have to play good defense. When we're up, we have to play very good offense. Okay, and that's one of the real, you'll find one of the real characteristics amongst most of the Aktie traders. They know when to play good defense and they know when to play good offense. Okay, and as we mentioned, the account reinvestment, okay, is simply a compounding effect. The account reinvestment is just simply, okay, and this is an important concept that you will see as we work through this tool time after time. But every single day, at the start of the day, when you load up the tool, it's going to ask you what's your account balance, okay? And what this is for is that the risk strategy you adopt is consistent. It never changes, okay? You will select one risk strategy, you will input the metrics, and you will follow that risk strategy for a specific period of time. You will not change it for a specific period of time, okay? What will change over that period of time is your account balance. And every day you are going to update the tool with your account balance. Okay, why? Because when your account is moving upward, okay, that's when you want to be taking on more leverage. And again, it's the wrong way to explain it. You're not taking on more leverage. What you're doing is you're learning to grow your account, okay, by taking the profits you've made on your account and reinvesting them into the market, okay, so that you can get this compounding effect. Now, the reason I say it's not more leverage is because 5% is 5%. Okay? If you invest 5% of your $100,000 account, okay, that's $5,000 a day. Now, if your account grows by 10%, so it grows from 100 to 110%, and you're now up 10% on the year, you're still risking 5% of your account. That doesn't change. The strategy never changes. You're just now reinvesting an additional $500. So your daily stop is now $5,500. You're just simply reinvesting those $500 additional profit into your next potential trade opportunity. Okay, and over time you'll see how powerful this is for building an account, for starting to understand risk a lot better. Okay, so this is what it looks like. This is the end now of part one. When we come back, I'm going to take you through the tool. Okay, this is what the tool looks like ultimately. If you haven't downloaded the tool already, go through the download video. Go and get everything sorted. Make sure that your virus software is up to date. Make sure you've got the tool ready to go so that you can follow along with me in part two.